You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by Purepoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit purepoint.ca to access in-depth market briefings, sector analysis, and the inaugural Behind the Curve report, understanding when and how the uranium market turns. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's May 12, 2026, and this week on Uranium Spotlight, flooding disrupts northern Saskatchewan uranium operations. A new CME uranium futures contract could reshape market liquidity. Ireland revisits its nuclear ban, and NexGen expands high-grade mineralization at Patterson Corridor East. The uranium spot price opened last week at $86.05 a pound, U3O8, and closed Friday at $85.85. Trading activity remained relatively steady through the week as investors continued to weigh tightening long-term supply fundamentals against short-term macro uncertainty. What stood out most last week was not price volatility, but growing recognition of how vulnerable uranium supply chains remain to disruption. Flooding in northern Saskatchewan temporarily impacted transportation infrastructure, supporting Cameco's operations at Key Lake and McArthur River, once again highlighting how concentrated and fragile global uranium production really is. At the same time, utilities continue to contract cautiously, despite a market where replacement supply is becoming increasingly difficult to bring online on schedule. Long-term uranium prices continue to hold at incentive levels near $90 a pound, reflecting the reality that future supply growth requires significantly higher sustained pricing and long development timelines. Yet even at these prices, very few greenfield projects globally are actually working towards production fast enough to close the coming structural gap. Financial interest in the uranium sector also continues to build. Growing institutional attention, renewed nuclear policy support globally, and the increasing politicization of energy security are all reinforcing uranium's strategic importance. For investors, the key takeaway is that the uranium market is increasingly being shaped not just by supply deficits, but by operational fragility, infrastructure constraints, and geopolitical risk. In a market where very little spare production capacity, even temporary disruptions matter. Last week, severe flooding in northern Saskatchewan caused the collapse of a major bridge used to help resupply Cameco's McArthur River and Key Lake operations. Alternative transportation routes were also heavily restricted by flooding, forcing Cameco to suspend operations at Key Lake and reduce activity at McArthur River while logistic challenges were being assessed. Cigar Lake operations were not impacted. Although Cameco stated it was not revisiting its 2026 production guidelines at this time, the event served as another reminder of just how exposed uranium supply chains remain to infrastructure and weather-related disruptions. Northern Saskatchewan hosts the highest grade uranium deposits in the world and remains one of the most politically stable uranium jurisdictions globally. But the region is also vulnerable to increasingly unpredictable climate events ranging from flooding to wildfires. Investors may remember the flooding event at Cigar Lake in 2007 that contributed to one of the largest uranium price spikes in market history. The broader issue is not simply a temporary operational disruption. The uranium market today operates with very little excess capacity. Utilities are already relying on inventories, delayed projects, and optimistic production assumptions to bridge future supply gaps. When weather events disrupt even a single key operation, it reinforces how thin the margin for error has become. Infrastructure investment is now becoming strategically important to future uranium supply reliability. Roads, bridges, powered systems, and transportation corridors are no longer secondary considerations in uranium development. They are becoming critical components of energy security itself. For investors, this matters because the uranium market is entering a period where operational resilience may become just as important as grade and scale. Supply disruptions, even temporary ones, can have an outsized impact in a market already struggling to bring on new production fast enough. The CME Group is preparing to launch a larger physically backed uranium futures contract, a move that could significantly increase institutional participation in the uranium market. While uranium futures contracts already exist, the current market remains relatively small and illiquid. Existing contracts reportedly have minimal open interest and very limited trading activity. The new CME structure is expected to be more closely aligned with the needs of larger financial participants and commodity investors. The importance of this development goes beyond simple trading volume. Uranium remains one of the least transparent major commodity markets in the world. Spot transactions are relatively thin, pricing mechanisms are fragmented, and physical supply is tightly controlled. A more active futures market backed by physical uranium could dramatically improve liquidity, price discovery, and investor access. The uranium associated with the contract is expected to be stored through COVERDYNE, one of the few facilities licensed to handle and store uranium material in the United States. This creates an important bridge between financial markets and physical uranium ownership. At the same time, global uranium fundamentals continue tightening. Western utilities are competing for future supply in a market increasingly divided along geopolitical lines, while mine depletion, delayed project development, and permitting challenges continue to restrict new production growth. Inventories in both the United States and Europe have already been drawn down substantially from historical levels. What makes this especially important is timing. Financial participation in uranium has historically accelerated during periods when physical availability tightens and long-term contracting begins to intensify. A larger and more accessible futures market could amplify that process considerably. For investors, this matters because greater financial participation can accelerate price discovery in a structurally undersupplied market. If institutional capital begins to flow into physically backed uranium exposure at the same time utilities are competing for long-term supply, the impact on both uranium prices and uranium equities could be substantial. Political support for nuclear power continues spreading globally, and last week Ireland became the latest country to publicly revisit its long-standing opposition to nuclear energy. Members of Ireland's parliament publicly supported overturning the country's 1999 ban on new nuclear plants, while Irish Prime Minister Michael Martin also expressed support for exploring nuclear power as part of Ireland's future energy mix. Ireland's situation reflects a broader global reality. Countries heavily dependent on intermittent renewable energy are increasingly confronting the challenges of maintaining reliable baseload energy systems. Ireland has made substantial investments in wind generation and continues developing offshore wind capacity, but the limitations of intermittent generation remain difficult to overcome without large-scale storage solutions that do not yet exist economically at grid scale. At the same time, geopolitical instability continues reshaping global energy priorities. Europe's energy security concerns remain elevated following years of disruption across fossil fuel markets, while governments increasingly recognize that nuclear power provides reliable, emissions-free electricity with domestic energy security advantages. The significance here is less about Ireland itself becoming a major uranium consumer and more about what it represents politically. Countries that once viewed nuclear power as politically untouchable are now reopening the conversation. That shift is occurring across Europe, Asia, and even parts of North America. Every additional country reconsidering nuclear energy adds incremental long-term demand pressure into a uranium market already facing significant supply challenges. Yet despite growing policy support for nuclear expansion globally, very few new uranium mines are advancing quickly enough to support the scale of future reactor demand currently being discussed. For investors, this matters because the political narrative around nuclear energy continues to improve globally. Demand growth is no longer dependent on a handful of countries. Instead, nuclear power is increasingly becoming part of a mainstream energy policy discussion worldwide, creating a broader and potentially more durable foundation for future uranium demand. NexGen Energy reported the final batch of 2025 drill assays from its Patterson Corridor East discovery last week, continuing to demonstrate both the scale and continuity of high-grade uranium mineralization only 3.5 kilometers from the Arrow deposit. The headline results were impressive. Hole RK25-239 returned 13 meters grading 5.2% U3O8, including half a meter at 30.2% U3O8, while RK25-240 returned 10 meters grading 3.95% U3O8, including half a meter at 33.3% U3O8. Additional holes confirmed continuity across the growing high-grade domain, while a new high-grade subdomain was also confirmed at depth. Importantly, the mineralization remains open in multiple directions. What continues to stand out about Patterson Corridor East is not just the grades, but the geological similarities NexGen continues drawing between PCE and the nearby Arrow deposit, already considered one of the world's premier undeveloped uranium projects. The company also emphasized that 2026 drilling has already expanded the system further, with more than 29,000 meters of the planned 42,000-meter program scheduled to resume later this month. This matters strategically because the Athabasca Basin remains one of the few places globally where discoveries of this scale and grade are still possible. In an environment where utilities are increasingly concerned about future supply reliability, large high-grade discoveries located near existing development infrastructure become exceptionally valuable. For investors, the key takeaway is that Patterson Corridor East is increasingly looking less like a satellite target and more like a potentially significant standalone mineralized system. Continued expansion of high-grade zones near Arrow strengthens NexGen's long-term strategic value at a time when the market is desperately searching for future Tier 1 uranium supply.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by Purepoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit purepoint.ca. Join us again next Tuesday for another edition of Uranium Spotlight.